Hey everybody, today must be my lucky day because I got Tyler to agree to come on and talk about SoFi. I don't think we've ever done a SoFi video, Tyler.
I think we did one once. I said a few things. You're like, I'm never doing this again.
Fair enough. But we're going to dive into the latest quarter and, why I like it. Let's see if we can make a believer out of Tyler too. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support what we're doing here on YouTube. Again, fool.com/Frankel. So, Tyler, let me just share my screen real quick because this was a pretty stellar quarter. SoFi's stock has roughly doubled from its 52-week low. It's been a very, very good year for shareholders. It was kind of stuck at like $7 forever, and now it's about a $14 stock. And if you look at these numbers, it's not that surprising that it's performed well. Whether or not you like it for the business is another thing, but it's not surprising that the stock has done well. You can see the membership base, it's still growing very rapidly, up 35% year over year. At this stage of scaling, that's really impressive to have maintained that level. If we look at the number of products, like a checking account, an investment account, each of those is a product, that's up 31% year over year. That percentage being lower than the percentage of customer growth tells me that they're not cross-selling as well as they could be, is one of my big negatives of this quarter. But when we look deeper into the numbers, let me see real quick. Oh, and another reason why investors are very happy with the stock before we get into like revenue and earnings and things like that, this is what they call the financial services productivity loop. And I can see Tyler kind of giving a skeptical look here. I'm going to kind of explain what this means. So on one hand, if you look at all these bars in the middle of the table right here, the light blue here is the number of financial service products, say like checking accounts, credit cards, investment accounts, things like that. The bottom number is the number of loans that SoFi has on its books, mostly personal loans, student loans, some mortgages. The idea is that the larger the ratio of financial service products to lending products gets, the easier it is to sell products to its existing members and not pay to acquire new customers elsewhere. Whether or not that's panned out in the numbers so far is something that I question, because as Tyler correctly pointed out to me before we started recording, SoFi's expenses haven't really gone down in line with what you might expect at this level of scaling. But regardless, over the past year, the ratio of financial services to lending products has increased from 5.6 to 6.2. So it's making progress in that area as well. We're just going to look at the numbers real quick. I promise I'm going to get to the numbers at some point. Tyler brought this up before the show, so I wanted to talk about it. He said their loan provision is actually going down in contrast to a lot of other banks. And this is why. The top line is the loss percentage as a percentage of principal on their earlier vintages of loans from 2017. You can see high loss ratio over the life of the loans. Almost 8% of the loan amount was of their lent amount was a loss, and their later vintages, meaning everything originated, from the fourth quarter of 2022 on, is tracking significantly better than their earlier loans. So as they get more cautious with underwriting, is really the way to say it. Their loss ratios are going down just because they're being a lot more selective on who they're lending money to. They're intentionally slowing growth in the lending business over the past couple years, and it's had that effect. Just kind of going through real quick, you can see on the top and bottom lines, so revenue is up significantly, 30% revenue jump year over year, which is a lot for a bank. I don't really put too much stock in adjusted EBITDA. You can all look up what Charlie Munger had to say about that as a metric. I'm not allowed to say it because it's a family channel. But if you look at adjusted revenue compared to SoFi's profitability metrics, this is a number I care about. This is not adjusted net income. This is GAAP profitability. SoFi is a nicely profitable business now. That was not the case up until about a year ago. I want to say the fourth quarter of 2023 was their first profitable quarter, and they've maintained profitability ever since and have actually surpassed expectations. And just one more thing I wanted to show you from their earnings slideshow before we move on. And I shut up for a second and let Tyler talk. The deposit base. SoFi has only, if you're not familiar, SoFi has only been a bank since early 2022. They got a banking charter through an acquisition. So they started their deposit base from zero at the beginning of 2022. They were relying on borrowed money to finance all of their loans until that point. That's no longer the case now. They've done a great job of acquiring savings and checking customers and have really built their deposits up. You can see right here, deposits are at 24.4 million. That is almost enough to cover their entire loan book without any other borrowing or sources of capital. You can see these where you say warehouse facilities like these right here. That's borrowed money. That's them borrowing money. Deposits are a generally lower cost way to fund lending than borrowing money. So the deposit base has grown really significantly, especially since it started at zero not that long ago. So that's where SoFi stands today. Before I talk anymore, Tyler, what are your general thoughts here?
Well, I kind of bucket it into things that I believe and things that I don't believe. I think that a lot of the thesis around SoFi is this very fast moving digital only business, which means if it's digital only, it can be much lower cost than its competitors. And all of these non-banking services or fees are going to be like one of these big differentiators for it, and that's where I don't necessarily buy it. Like you mentioned earlier, as much as that sounds good on paper, those non like interest income or sources have not been as large as I think people have expected, despite the revenue growth. Like revenue growth for its technology platform, for its loan origination, for a lot of those non, traditional banking sort of things have been way up. But so have the costs for that, like significantly, to the point that the non-interest op income was only $60 million for this quarter, despite several $100 million increases in revenue. As you alluded to offline, customer acquisition costs are real, and when you're signing up a lot of people with high customer acquisitions costs relative to your competitors, it's going to affect things like non-interest operating income. So, the thing that I do buy though is that this is from a banking side, it's quite profitable. For the quarter, it was $431 million in net interest income from its banking. So, net interest income from the difference on what it lent and what it borrowed, which is great. It has probably, in terms of banks, one of the higher net interest spreads that you can see in banking today. Now, that is in part by design. Most of its loan book is in personal loans, which are either student loan refinancing, private loans, things like that, which, it's great because it's like I said, high net interest, but it's also a little bit higher on the risk spectrum of lending. And so, one and on top of that, it's like it's all consumer only. It doesn't have real estate loans for commercial real estate or business loans or any of the other kind of things. It's very much the individual focused. It's working for them. And to me, I kind of compare it a little bit to Capital One in the sense of like when you have these slightly higher risk spectrum kind of lending, when it's good, it's great. And I think that the numbers really bear out that in SoFi's numbers. The thing is when it does get bad, when you do hit recessionary times, when consumer credit is stretched and maybe people aren't covering everything as they used to, that's when things can get ugly pretty quick, when these higher net interest income kind of sort of businesses. And so I will be very interested to see what happens with a company like SoFi when we're not in a, credit is great sort of environment.
Yeah, and that's fair enough. And one thing I wanted to point out is you mentioned their expenses are staying high. They're not as profitable as you would kind of expect them to be given the growth. They're very profitable on the banking side, but not on some of the other sides of the business. And they're quietly making a lot of changes in the past just few months that a lot of people aren't really aware of, that they're trying to change some of this. They've been giving away a lot of things they could sell. Is one of the worst things you could do in business is give away something people are willing to pay for. For example, their robo-advisor platform. They have an investment platform. Some of it's an automated platform. They were the only one that I knew of that had no management fee. They just they just kind of relaunched it with a new management fee of it's a quarter of a percentage point a year. But if you're managing billions of dollars of client assets, that can become a significant revenue source that they weren't getting before. Now they're only doing certain things or offering certain perks to people who are willing to sign up for direct deposit. For example, if I do a recurring deposit into my SoFi investment account, I get a 1% match. That used to be for anybody who had a recurring deposit. Now you have to have direct deposit through a SoFi checking or savings account, kind of the cross-selling thing I was talking about. They're starting to do more loans, and Tyler would actually like this. They're starting to do more loans for third-party businesses, essentially just kind of underwriting loans, but they're not actually making the loans themselves. They recently had a $2 billion agreement with outside investors to facilitate loans on behalf of third parties. So they get a nice fee income from it, but they're not taking on the risk that you correctly mentioned. Personal loans are great when the market's going great. But if you're just getting a fee to produce the loans, what do you care what the market's doing? And they're starting to build out their credit card portfolio, which isn't a lower risk thing, but it kind of makes them a little more. Right now, their credit card product is not bad, but I wouldn't call it impressive. And that's a high potential part of that business. They like to be innovators, so I'm glad to see them doing some innovating there. But generally, I like what they're doing. I think that these moves are going to pay off. They're not reflected in the numbers yet, obviously, but I think there could be a bright future here. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.